Hi there. Today we cover the most dangerous idea in futures trading, leverage. Look at the E-mini-S&P 500 futures, ES, daily chart on screen. With a relatively small cash deposit, you can control a large notional position. That same power means you can lose everything just as fast. The margin habits and position sizing we cover today are the insurance that keeps your account alive. Let's walk through it together. On this ES chart, the keyword is margin. You post only a fraction of the full contract value to trade. Think of a $3 coffee that jumps to $4.50. You put down a small deposit up front and settle the rest later. Futures margin is that deposit idea applied to a huge notional. For index futures like ES, initial margin is often roughly $12,000 to $15,000 per contract. Exact numbers vary by broker and by volatility regime. Always check yours. If your account holds $25,000, you still need enough free cash to maintain that margin, so you are realistically in a 1 to 2 contract lane, not a 10 contract fantasy.
옌 더 S&P 드랍스 어바웃 1%, 러플리 47포인트 니어 예이 4700 인덱스 레벨 1 ES 컨트랙트 루지즈 어바웃 달러 2350.
That is 9.4% of a $25,000 account in one move. Trading with no buffer is a fast path to a wipeout. A famous stress test is March 2020. The ES chart printed extreme volatility as the Fed and markets faced a sudden crisis. When volatility explodes, exchanges and brokers raise margin requirements. Institutions cut risk at the same time. Stops trigger more stops. In the worst tapes, the index can move 10% or more in a single day. March 2020 was one of those regimes. Retail traders? Many never get to place a clean exit. Margin runs short, and the broker auto-liquidates the position. Extreme days are rare, but leverage always behaves this way. A friend in calm markets becomes an enemy in a crash. On the WTI crude, CL, chart on screen, there is a hard rule for how large a position you take. One principal professional's hammer: never risk more than about 2% of the account on a single stop out. Say you have a $50,000 account, buy one crude contract and put your stop $2 away. 1 CL contract equals 1,000 barrels. $2 times 1,000 barrels is a 2,000 loss, for us in 2 of the account in one hit. You just broke the rule. Cut to a half size or a micro contract. Tighten the stop to about $1 or bring a larger account. That decision tree is position sizing. Rising volatility is the most dangerous phase because required margin can jump 2 to 3 times with little notice. Even a commodity like gold, GC, on screen can force margin calls when institutions liquidate together into a volatility spike. Warning light: when the big SIF clears 30, recheck how much risk every open position is really carrying in real time. The worst case stacks 2 hits at once. Your equity shrinks from losses while the margin you must post suddenly rises. Traders call that a margin spiral. In extreme regimes, the 2008 financial crisis, March 2020, forced liquidation can finish in hours to a few days. 3 practical defenses keep you in the game. First, a margin buffer. If required margin is $10,000, keep roughly $15,000 to $20,000 in the account. A conservative 150% plus of required margin is a common standard. Second, every morning check stops and mark-to-market P&L on positions like the E-mini-NAC and Q on screen. On high volatility Fed or risk-off days, check more often. Third, hedging. Think of it as insurance that caps the blow-up. Long in Q, you can sell a covered call or buy a protective put to limit the worst-case loss. Combine all three, and the account has a real chance of surviving an extreme market shock. Leverage is not evil. It does demand respect. On a volatile contract like copper, HG, on screen, leverage is both a scalpel and a bomb. Many pros aim for the same posture. Take small, high-probability wins often, and never let one oversized loss erase the account. Survival comes before profitability. Take today's position sizing, margin monitoring, and hedging into your own checklist. This lesson is educational, not investment advice. Every trade and every loss is your responsibility.